As of February 2026, the view of the blockchain market has shifted away from vague expectations towards strict standards of actual revenue, generation, and integration with institutional finance. At the center of this massive capital flow stands Arbitrum, which defines itself as a survivalist innovator and is rapidly expanding its territory. Arbitrum is moving beyond being a mere technical output to establishing the actual standard for digital finance. Arbitrum 1 made history by surpassing 2.1 billion cumulative transactions at the end of 2025, which is a staggering growth rate considering it took 3 years to reach the first 1 billion, while the second 1 billion was filled in just 12 months. As of February 2026, Arbitrum maintains its position as the undisputed leader in the Layer 2 market, with a share of approximately 41% and over $20 billion in total value secured. Behind this peerless scorecard lies a powerful weapon that competitors cannot easily imitate called stylus. To explain this for a general audience, if existing blockchains were old manual calculators that only understood a specific local dialect like Solidity, then Stylus has evolved into an AI-based supercomputer that perfectly processes universal languages, like Rust or C++. Previously, Web3 developers had to operate within the narrow framework of the Ethereum virtual machine. But now millions of Web2 developers can design complex financial algorithms or high-specification, on-chain games on Arbitrum, using languages they are familiar with. Stylus operates a WebAssembly virtual machine in parallel with the Ethereum virtual machine to process complex computational tasks, thousands of times more precisely and cheaply than before, which acts as a decisive incentive for decentralized exchanges or AI-related applications that handle massive data to choose Arbitrum as their destination. The practical effectiveness of Arbitrum is most clearly demonstrated in the field of real-world asset tokenization, also known as RWA. The actions of BlackRock, the world's largest asset manager, are the most symbolic examples showing that Arbitrum has entered the heart of institutional finance. BlackRock integrated its BUIDL fund with the Arbitrum ecosystem to create a structure that directly delivers U.S. Treasury yields to on-chain users. And this fund reached a historical milestone by surpassing $100 million in cumulative dividends by the end of 2025. This case, which once recorded a peak of $2 billion in assets under management, has ingrained in the market that Arbitrum is a unique infrastructure where institutional-grade assets can safely reside. Furthermore, the global fintech giant Robinhood launched a public testnet for its own Robinhood chain built on Arbitrum technology on February 11, 2026. Robinhood is operating a system that tokenizes over 2,000 stocks and exchange-traded funds for European customers, allowing for 24-hour trading and instant settlement. And as of February 2026, the value of these products has exceeded $15.1 million, proving the existence of actual demand. The depth of partnership extends to Spico, a France-based asset manager. Spico achieved the feat of securing over $200 million in assets under management on the Arbitrum network within 12 months of its launch, while traditional asset managers like Franklin Templeton with its Benji token and Wisdom Tree, with its treasury-linked products, are also enriching the ecosystem liquidity. With support from the Arbitrum DAO STEP program, the Arbitrum DAO has allocated 35 million ARB tokens to this RWA initiative to actively support the on-chain inflow of traditional financial assets. And thanks to these efforts, the stablecoin supply has grown 82% year over year to reach a scale of $8 billion. This means Arbitrum has grown into a financial hub, with the deepest and most diverse on-chain dollar liquidity among Layer 2 networks. From a mid to long-term perspective, the key variable that will determine the future value of Arbitrum is the major transition in tokenomics scheduled for 2026. The Arbitrum DAO passed a temperature check proposal to reward ARB token holders who stake and delegate their tokens with a portion of network revenue, with 91% overwhelming approval from more than 25,000 participants. This is a historic event that changes the nature of the ARB token from a simple voting right to a yield-bearing asset that generates actual cash flow. According to the specific design, 50% of future surplus sequencer fees generated through network operations will be distributed to staking participants, and even under conservative analysis models, an annual reward rate of approximately 7% is expected. This value capture model will solve the chronic undervaluation of the ARB token and provide a strong investment incentive for long-term holders. thereby further strengthening the economic security of the network. However, the market must also coldly observe the risk factors. The most powerful competitor currently threatening Arbitrum is Base from Coinbase. Base occupied more than 60% of the total Layer 2 transaction volume as of the end of 2025 and is chasing at a terrifying speed. If Arbitrum is an orthodox player armed with technical prowess and deep financial liquidity, then Base uses its accessibility to immediately onboard tens of millions of Coinbase users as its weapon, and was recorded as the only profitable Layer 2 in 2025, earning approximately $55 million. Additionally, the superchain vision of Optimism is attempting to dominate the market by forming an alliance of numerous chains and emphasizing interoperability. And if the market paradigm values seamless movement between chains more than individual chain performance, then Arbitrum's strategy of emphasizing independent sovereignty may face risks of isolation. The most painful part of the internal risks is the massive token unlock schedule. Until March 2027, approximately 90 million to 100 million ARB tokens are being released into the market every month, which accounts for about 1.5% to 2% of the total circulating supply. This continuous oversupply acts as a chronic downward pressure that suppresses price increases, despite strong technical fundamentals. Furthermore, internal governance conflicts and trials such as the discussion to recall approximately $120 million in unused funds from the Gaming Catalyst program, due to its failure to meet deadlines, are also acting as risks to investor sentiment. Nevertheless, experts analyze that the value creation mechanism built by Arbitrum is completing a perfect flywheel structure for a platform business. Arbitrum introduced a transaction ordering auction system called Time Boost in 2025, which generated over $6 million in additional fee revenue in its first 7 months. And this is the result of a sophisticated design that converts value generated within the network into DAO revenue, rather than letting it be taken by miners or external forces. Also, by officially activating the permissionless validation system called BOLD in early 2026, Arbitrum has completed a system where anyone can monitor the network for fraud and raise disputes. This has become the final puzzle piece to realize true decentralization as a stage 2 rollup and fully inherit the strong security of Ethereum. From a long-term investment strategy standpoint, it is clear that Arbitrum is one of the few winner-take-all chains that will survive the large-scale restructuring of the Layer 2 market. After 2026, projects that move only on vague expectations or marketing will be weeded out, and a fundamental-driven reorganization will occur, where only projects that prove actual revenue and user metrics survive. Arbitrum has already proven its reliability by protecting over $20 billion in assets, and its future value has strong downside rigidity, given that it has secured powerful allies in institutional finance like BlackRock and Robinhood. As of February 11, 2026, the price of the ARB token is trading near $0.11, but analysts predict that it will pass through a technically oversold zone and attempt to recover to the $0.25 to $0.28 range. The vision of Arbitrum is to move beyond simply assisting Ethereum to becoming the standard settlement layer, where all financial assets in the world flow. By 2030, it is expected that a significant portion of global financial assets will be tokenized and distributed, and there is a high possibility that Arbitrum will be the home of digital finance, where those assets are traded most safely and quickly. The $150 million in non-native assets and over 3352 ETH in surplus revenue, currently held by the Arbitrum DAO, serve as powerful fundamental strength to expand the ecosystem and support innovative teams under any market crisis. Especially the fact that the DeFi Renaissance incentive program known as DRIP, which injected 80 million ARB tokens equivalent to $40 million to provide liquidity, resulted in a 696% growth in the market size of lending protocols like Morpho, is evidence of the self-sustaining power of Arbitrum. In conclusion, Arbitrum will move toward the two goals of establishing the revenue-sharing model and the full-scale inflow of institutional financial assets throughout 2026. While fierce challenges from competitors and the risk of massive unlocks coexist, the deep liquidity and technical superiority of Stylus built by Arbitrum are a fortress that will not easily collapse. Investors should focus on the process of Arbitrum, establishing itself as the core infrastructure of global finance, rather than the noise of short-term unlock volumes. Arbitrum will prove its value eternally as a survivalist innovator that creates new rules for the digital economy beyond just surviving.